Hello there traders, welcome to module 43, how to use moving averages to enter trades. Moving averages, or MAs as you know by now, have a wide range of uses and can be combined with several other indicators to provide you with the information you need to trade wisely. Let us break these down for you. With trends as their most basic level, MAs can help you figure out the current price trend. If you plot a simple moving average, or SMA as it's known, on your chart, it squiggles tops and bottoms with define in what direction prices are swaying. If prices are riding above the SMA, then this means the market is experiencing an uptrend. On the other hand, if prices fall below the SMA, then downtrend is the name of the game. However, plotting just one moving average on your chart does not provide you with enough information or sufficient data to ascertain that a trend is reversing or staying on course. Hence, it is always a good idea to add two MAs to your MT4 to confirm your hunch as to where prices are headed. As long as the moving average for the shorter period 10 runs above that for the longer period 50, let's say, then you know that the market is trending upwards. In the image above, you can clearly see that the 10-day SMA in red running well above that of the 50-day SMA, which is in blue, signaling that the market is going through an uptrend. Now this goes the same for a downtrend. The longer period, 50 let's say, should run above the shorter period, 10. And this reading applies regardless of how many MAs or moving averages you plot on your chart. What is with crossovers, let's say? Now, both the golden cross and the death cross point to the crossing of a short-term moving average over a long-term moving average, a sign that a long-term trend is consolidating sideways. However, as their names suggest, the trends set by each are exact opposites. The golden or a golden cross establishes a long-term bullish market where the short-term moving average crosses over the long-term moving average and pushes upwards. On the other hand, a death cross confirms a long-term bearish trend with a short-term moving average crossing over the long-term moving average on the downside. As soon as the cross occurs in both scenarios, the long-term moving average becomes a support level for the golden cross and a resistance level for the death cross. So, what you've got to do is keep an eye out for these crosses as they present ample of opportunities for you to make a move, open or close some positions and earn some money. To set up this strategy, you need to add two moving average lines to your chart. The first one is your 50 and the second is your 200 MA. With support and resistance levels, generally speaking, moving averages does make for great support and resistance levels as well. However, unlike the irregular and rather rigid support and resistance levels, the levels that you are used to, moving averages are dynamic, shifting and floating as the market moves. Many traders use moving averages as support and resistance levels, going long when prices drop, for example, and repeatedly bounce off the moving average and going short when prices move up and test it often or frequently. Some traders work with what is called a zone, not a level, setting up two moving averages, let's say 10 and 20 day, and only trading when the candlesticks are in that gap or zone created by the two MAs or moving averages. Also, keep in mind that just as with your traditional support resistance levels, prices can break through, switching your moving averages role from support to resistance and vice versa. In the following image, you can clearly see the 50-day EMA acting as both support and resistance for the price of the GBP USD, let's say. With envelopes, to avoid being faked out by moving averages and being tricked into a trade in an uneasy market, many traders use what are known as moving average envelopes. Moving average envelopes is a filter of sorts in which a line is drawn a certain percentage, let's say for example the 5%, above and below the MA. Only once prices break through this filter is the trader convinced that the trend is set and it's safe to open or enter the market. Here's an example of envelopes for a 50-day EMA for GBP USD set at 5%, let's say. Generally speaking, envelopes were designed to curtail the damaging effects of whipsaws or the sudden and quick shifts in direction by a financial instrument. Like whiplash, but only painful to your bank account and morale as a budding trader. You can set these up very easily on your MT4 and customize them to your liking. One main concern with using envelopes is that they delay a trader's move, potentially eating into his or her profits. Let's talk about ribbons. Last but not least, we have got moving average ribbons or multiple moving averages of different sizes added to the same chart to create patterns that slightly resemble ribbons. Most traders will use 8 to 15 MAs set at different intervals, say 15, 30, 40, 45, right up to 75, 90, and so on. In the image below, this is where you could actually look at the aforementioned MAs for GBP USD, for example, of what they will end up looking like. So how do we read these CY Trombley inspired doodles as we see? Basically, when the candlesticks have surged above most, if not all, the MAs, then you know we are on an uptrend. Conversely, if the price has dropped below most of the MAs, then this confirms that the market has turned bearish and it's time to sell. Also, the widening and thinning of the ribbons have a story to tell. Generally, if the ribbon fattens up, it means prices are strengthening and pushing north. On the other hand, if the ribbon's gone on a hunger strike, let's say, and is losing its girth, this signals that prices are pulling back. Finally, if the MAs start crossing over each other, then this marks a potential trend reversal.